Good morning. Myself, Mrs. Bijal Anandatu, and today we are going to start with FIBMS Semester 1 subject, that is Introduction to Financial Accounting. Very interesting subject, as it's accounts, it's always interesting. Now the entire syllabus of your financial accounting has been basically divided into 4 modules, and we will cover all 4 modules one by one. Now let's start with module 1, that is Introduction to Financial Accounting. In that module 1. Now module 1 consists of, in module 1 what we are going to learn is, first one is meaning and scope of accounting. Then we are going to learn about the accounting principles. After that we are going to learn about the Introduction to Accounting Standards. Once accounting standards are done, we are going to learn about Introduction to IFRS, which is Globally Accepted Accounting Standards. I'll explain you in detail. And the last one is Accounting in a Computerized Environment. So the entire module 1 consists of 5 of these chapters. Now let's start with chapter number 1, that is Meaning and Scope of Accounting. Now, before I go, what is accounting? What is the need of accounting? What are the various terminologies? First, basically, I'll have to look for the base of the accounts. Now, let us understand, accounting is an advanced stage, or you can say accounting is a secondary stage. So, before you reach to the secondary stage, you must learn what is the primary stage or what is the base of the account. So, you must learn about what is bookkeeping and the need for the bookkeeping. Now, before learning accounting, we should learn what is bookkeeping. So, bookkeeping is nothing but it is an art and science of recording and classifying all the business transactions which are happening during your accounting year into one set of books. So it just records and classify your business transactions in a set of books, in account books which you are maintaining. Now, what are the objectives or a need for the bookkeeping? From bookkeeping, what we come to know is that it becomes, first of all, we come to know about the date-wise transaction which has happened over the entire year, because all the transactions are recorded chronologically and as per the date-wise. Second, it becomes our permanent record for future reference also. Suppose in future we want to see about the past events on a particular date, we can refer those events through bookkeeping records. It is very useful for our income tax purpose. It is very useful to government also. And it becomes, we can also keep record of our income and expenses as well as what are our assets and liabilities of the business. That also we come to know from our bookkeeping. Now let us jump to what is accounting. Accounting, as I earlier said, it is a secondary stage or it is an advanced stage of bookkeeping. Where the bookkeeping ends, accounting starts. So accounting is not only recording and classifying the business transaction, but it also involves analyzing and interpreting those accounting records or those accounts. So it involves recording, classifying, analyzing and interpreting the financial transactions which has happened during the entire year. Now from accounts, we saw in bookkeeping, we come to know about our income, expenses, about our assets, liabilities. Once we analyze those transactions, we interpret those transactions, we further go into detail and we come to know the profit and loss of the business. Whether we are earning a profit for the entire year or whether are we suffering from the losses. Again, it is a permanent record. It is useful for our income tax purpose. From this record, we come to know how much taxes we have to pay. Government will come to know what are the taxes which is going to collect from a particular business organization. Also, we come to know about our financial position of the business, assets and liabilities. From that, we come to know about the net worth of the business, where we are standing, how much is our assets, how much are our liabilities, how much are our long-term liabilities, short-term liabilities, etc. So, accounting is a very detailed concept as compared to bookkeeping. Next, now who are the persons who will be interested in your accounts? Understood? Who are going to look after for your accounts? The first foremost is the owner himself. Now, owner is the one who starts the business as well as he brings money, he brings capital to the business to run the business. He is the one who will be very much interested. Why? Because profit hua to usko jayega, loss hua to he is the only one who is going to suffer. So owner is the most interested person in your accounts. After owner, the second person comes is your employees of the business. Now, employees are the one who work for the company. Now owner starts the business, owner also works for the company, owner brings cash also into the business. But employees are the main manpower who works for the company, who works for the organization. So they will be interested, and from the accounts they will come to know whether in an organization in which they are providing their services, are they going to get their salaries or not, but whether it is a stable organization in paying them their salaries and their perquisites and all the benefits which is acceptable to them. The third person are the lenders. Now lenders are the persons who provides finance to the business. See, as an owner, I have brought the capital, but I won't be having that much capital to run the business. So for that, I'll have to take the help of lenders. Now lenders will provide me funds. Definitely they will be interested to see that the funds which they have provided to a business organization, that organization is in a position to repay that funds along with the interest. Another person who is interested is the debtors. Debtor means the person to whom you sell your goods. Customers, in a simple words, layman language. Next one is the creditors. Creditors means from whom I am purchasing my goods, who provide me goods on a credit basis and gives me 2 months, 3 months time period to pay back the money. And the most important, most interested person will be the income tax authorities and the government. Why? Because they are the one who is going to collect the tax. So government will come to know how much tax, how much GST, how much service tax is that going to earn from that particular business. So these are the entities who will be interested in your accounts. Now, before we go further into accounting and everything, we must learn some basic accounting concept or some basic accounting terminologies which we normally use when we use the accounts, when we write the accounts, when we read the accounts. So the first one is transaction. Now, I earlier said it is a recording of a business transaction. Now, but what is a transaction? Transaction means, in a simple layman language, it means exchange of something between two persons. I am exchanging something with you. So that is called as a transaction. Now, further go into detail, transactions are of two types. It may be of a cash transaction or it may be a credit transaction. When I say it is a cash transaction, it means goods and services are exchanged for immediately in cash. If I'm buying you something, in return I'm paying you immediately cash for it. Okay, so it is a cash transaction. The other one is a credit transaction. In that, you are going to pay for the transaction but not immediately in cash. It is not immediate payment in cash, but later on, after a 15 days or a 1 month period of time, you are going to pay cash for it. So it becomes a credit transaction. Now we saw transaction means exchange of goods and services. So first we also have to learn what is a goods. Goods means any kind of tangible property which you can feel, which you can see, which you can touch, which is useful for your future reference. That becomes goods. Again, services means something which is intangible in nature, but you are taking the benefit of it. Say for consultancy services, doctorate services, lawyer services. They do provide services. You take the advantage of them. You take advice from them. So you cannot see the services, but you can feel the services. You can take experience of it. So these are goods, cash transaction, credit transaction, services, meaning of transaction. After that, we are also going to learn about what is my income, what is my expenses. Now, when I am exchanging goods, I am charging you money from it. So whatever the income which I am getting, whatever the profit, whatever the money I am getting, that becomes my income of the business. Income means the sales revenue generated from my operating activities of the business. And to earn that sales revenue, if I am paying something in cash, that becomes my expenses. Now, on the other hand, if your income is more than your expenses, it's a good sign. You are earning a profit. But it's not always the case. Sometimes your expenses may be higher than your income. Then it's not a good sign, you are suffering a loss. So here we saw what is income, what is expense, what is profit and what is loss, which are very most important terms for the business organization. After that, we come to our assets and liabilities. Now, assets means some tangible property or an intangible property on which I have the ownership. I am owing that ownership. I am owing that property. On the property on which I have my ownership, that becomes my asset. On the other hand, liability means something which I owe to others. I owe to outsiders. I have to pay the money to the lenders, to the financial institution, to the banks from which I have taken for my business purpose. That becomes my liability. Now this liability may be a short-term liability, which may expire within a year. It may be a long-term liability, say a loan or a housing loan or a business loan, which may take 2 to 3 years or 5 years down the line you are going to pay. Now some liabilities are called, very important to see, contingent liabilities. Now what is a contingent? Meaning of contingent liability is what? Some liabilities are like, today as of now, you are not totally aware whether that liability is going to occur in future or not. The occurrence of that liability is completely unsure. You don't know whether it is going to happen or going to incur in future or not. So that becomes your contingent liability. It may occur in future, it may not occur in future. So that is called contingent liability.